Hope everyone is doing well. This is going to be a video over the 21st of July. So overall, it was a good day for the Bulls. The Bulls, they tried to retest the July 8th high on the open. Then they sold off July 8th and turned up sharply. They, more importantly, closed above the June 28th high, which was probably the major lower high, or not one of them, but it was a double tops, breakout above a double top. So we closed around 4,000. We're probably going to reach these highs pretty soon. We could easily get two legs up. It was really important for the Bulls to get consecutive closes above these highs. So that's a problem for the Bears, and it increases the probability of a couple of legs up. And hopefully for the Bulls getting back to the June high. The Bears, what do they want? Well, they want a wedge, but that's pretty difficult for the Bears. First reversal down is probably going to fail. Even if the next bar is a big bear bar closing on its low, it's still a pretty tight channel up. So good bar for the Bulls on the open tomorrow. It'd be good for the Bulls if they can keep this gap open. And, by the way, there's been a lot of people talking about funded accounts. And a funded account is pretty similar to, let me see if I can pull one up, an example. So here's an example of a funded account. And what a funded account allows you to do is you go through a simulated trial period where if basically if you can make $6,000, they, in theory, give you $100,000 in capital to trade with, real money. You can trade 14 contracts, and you get to keep, 90% of what you make. And often they do a promotional where, you keep the first 10,000 before they get nothing. Now, there's one hidden problem with funded accounts, and that is the trailing drawdown. And if you look at it, any one of these, $6,000 is basically what you have to make. The problem, though, is you only get a trailing drawdown of $3,000. So what does that mean? That means that if you were trading something like the micros, that trying to think of an easy example. Let's say you're long, price goes all the way up to here. Well, and you get stopped out on this bar as it goes outside down. Well, you did not, if you bought this close, price went up to here, stopped you out here, in theory, you'd have a small loss here to here. But trailing drawdown means you had a loss from this high tick to this close. And even though this was all open profit, you still would have lost 71.75 to 49.5. So 71 minus 45, 22 points. So you'd have lost $110 down on your trailing drawdown. So instead of $3,000 of a trailing drawdown, your trailing drawdown now would be $2,890. And the other problem is you basically have a $3,000 account. So if you have a $3,000 account, your 1% risk is $30. So you just lost $110 on a $3,000 account. You just lost 3.6% of your trading capital in one trade. Well, let's say I'm trying to think of another example. If you pick any of these, if you lose, it wouldn't be that difficult to necessarily lose 5% in a day. And the other problem is you got to double your account. So you got to make $6,000 on a $3,000 account. Do the math. And what that will force you to do, even if you can make 1% a day, that is going to take, 100 days? It actually wouldn't take 100 days. It would take 200 days. So if you can make it'd be something like that. I know that it would maybe not longer than that. So even if you could do that, it would take 200 days just to get the chance of trading this large, quote unquote, $100,000 account. And when you get it, you'd only get a $3,000 account. It's the same math for these. So if you think about it, it's a great business model for the people that run it. I'm not going to name the name of this one, but it's just an example of one I know. So, if I was going to own a online, anybody can join funding program, this is the easiest way to reduce risk, because think about it. How many people, super big, they're not prop firms, but they're kind of like them. How many people are going to try out? Probably thousands. And if you have, even if you have 300 people, it costs you $207 a month. 300, 207, $62,000 a month just on people simulating, trying to get a shot at this. Even if you have 10% of people lose this on their first try, you're still going to make money. And the ones that are actually good at it and actually make money, they still get a piece of the pie. Probably 80% of the people that are, probably 90% of these people doing the funded accounts are going to lose. And if the average person is on simulated for 6 months, then it's profitable. And if you do it the right way, maybe you're only risking 1%. It takes you 200 days. Well, 200 days divided by 30, that's 6 months. So 6 months times 207 is $1,200. So I would really be careful about these things. And, even if you go for the large account, $250K in capital is not $250K in capital, because if you lose, if you're trading, risking $250,000 in theory, your trailing drawdown is $6,500. So $6,500 divided by $250,000, it's 2%. You have a 2% drawdown in this account, you've lost. So when you look at these big, there's a reason these numbers are in big bold, and this number is kind of small, because this is really your account balance. It's not this. It's not this. You can trade 27 contracts or 54 micros. Okay, so let's take that first example. I'm going to trade 20 contracts on this bar, 905, and my risk is 22 points. So 22 times 50 times 20 is $22,000 risk. If the market goes up, I'm just going to assume I traded 20 contracts. If I sold this close, 49.5, the market retraced to 56.5. So 49 minus 56 is 7 times 50 times 20. This one move up, if I traded not even all the allowed amount of contracts, if I traded 20 instead of 27, okay, my max drawdown is this. If I sold the close with 20 contracts and the price went up to here, I would actually lose the trader evaluation in 5 minutes, even though it went down to here, because my trailing drawdown would have been $7,000 right here. So again, even if you can't even trade a full Emini, so you're really just better off, and I get it. Some people they can mirror, I think that's what they call it, where they'll open like 10 of these things, and then they have a bunch of $7,000 accounts. So what they'll do is open like 10 of these $7,000, they might open 10 of these where they have $6,500 accounts, and then they have a $65,000 account. But the problem is you're paying $5,000 a month on, a $65,000 account. So $65,000 divided by 5, you're losing 13% of your money every month. So, it's again, you would have to, it's a really difficult challenge, because it forces you, here's how I would sum it up. It forces you to risk more than you should and blow your account. It's designed to force you to blow your account. The reality is, no institutional firm is going to give somebody money, if it's a real institutional hedge fund, give somebody, and I don't know this, but I'm pretty confident of it, is going to give somebody these parameters to make money with. It doesn't make any sense. It would be very, very poor risk management. So it's designed for you to fail. Now, if there are some people who understand how to do it the right way and can make it work, I'm not saying that everybody that does it fails. I'm pretty sure Rose, she's used it before, but she's probably using it in a smarter way and telling people to not, have poor risk management. So I'd be very careful with that. And I wouldn't look at these big numbers. I'd look at this number, because this really tells you the value of the account. This tells you the value. So $6,500, but I got to pay $500 a month. It's 13% of the account balance. $207 a month, $3,000. Guess what that's going to cost? 15% a month for this. I'm better off just saving $3,000. So anyways, hope that little piece is helpful. I'm going to get back to the review in just a minute. So anyways, that's my thoughts on the funded accounts. So coming into today, let's talk about it for a minute. Likely to get a trading range open. We opened in the middle of the prior day's range, at least the afternoon range right here. Typically when you open the middle, most days are going to be a trading range, which means most days, if you open in the middle, it's probably going to go mostly sideways. So, bar one, well, first off, trading range open, and we sold off and then had an opening reversal up. It tested these lows, kind of an expanding triangle here and here. And I'll go more into detail on that, but I'm just kind of giving a high level. Strong trend, likely to go sideways to up for the rest of the day. And one of the reasons we sold off aggressively is we reached 4,000, but while it took a while, a lot of the fight was over let me add it back today, the June 28 high, which is this, I'll just make it purple, this purple line. Spent a lot of time right there, and then a lot of time back at the prior day's high. So on the open, big bar one, it is a big bar closing on its low. However, we get situated here. It's a big bar closing on its low, big risk on the open. Most of the time the open goes sideways, so you're really, probably better off waiting for consecutive trend bars, because the market may just go sideways. Bar two, that's even worse. Hang on. Well, let me do like this. Try to space the bars out a little. So here we go. Bar two is, if I can find it, it's a big outside up bar. So realistically, traders are expecting this sell to lead to a scalp. And the reason it's going to be a scalp is they know they're going to be disappointed. If you were confident that you could sell below bar one and it would go down 50 points, you would be more than happy to stay short. So you're only going to scalp out if you think or expect disappointment. So as this bar went down and started to stall and turn up, that's not what traders wanted it to do. So they're going to bail out of the trade and they're going to start buying back their short, which drives the market up. Then you get a really big bull bar. Well, tight channel down, consecutive bear bars. If you're buying here, your stop's all the way down here, and your risk is big. So traders may buy this close, but buy more lower. And some traders will try and buy a 50% pullback, thinking, it's trading range, the pullback may be deep, and it looks like a good buy. It looks like a good buy, but it may not be all that great of a buy. Bar three, second entry short, might be good for the bears, but again, a lot of overlap. It's basically a doji on a 15-minute chart, probably going sideways for the open. And, it's an okay swing short. It's not a great swing short. And it's the same problem here. Bears selling, if it starts to turn up, they're going to be quick to get out. So what do we do here? Bears sold the close, sold more higher, thinking trading range. got back out at the low close. Bulls bought this high, disappointed. What are they going to do up here? They might get out. Now right here, we had a bull bar closing above its midpoint. Special situation. You have a double bottom. So we went down and up, and then we went down and we went up. Here's the highs. If we break above the neckline, we could race up really high. We still might get a trend from the open. Very big bull bar, surprise bull bar, probably going to lead to a second leg up, right? However, what's the problem? Well, it's a wedge. 1, 2, 3. As good as this bar looks, and traders will buy the close. What you have to pay attention to is think about the logic of why you're buying the close of that bar. Are you buying the close because the market's really cheap or because it's expensive? You're buying because of the momentum. You're willing to pay a premium, a higher price, because you expect the market to go higher faster. Otherwise, you'd wait, you'd want to trade value. So if that's the case, what are you going to do when you see this? You're going to be thinking, gee, that's disappointing. I wanted another big bull bar. And if you wanted another big bull bar, you may get out of break even. Or you may just say, is this bar... Think about what happened on this bar. This bar opened right here and it started to go up, started to stall. You may just say, that's good enough for me. I'm going to get out of this trade. And, if we form another stop entry, I'll get long again. And that's what a lot of traders did. So a lot of traders started bailing out of this trade and we started failing and we started racing down. And this is also, why I often say most people are better off waiting for 6 to 12 bars before they place a trade. There's so much overlap, there's so much back and forth. It's so easy to get really chewed up, and it can take the whole day. It can take multiple days to make back what you lost. You sell below this bar, you buy above this bar, sell, and then you buy, and then you're so upset. Even if you sold here, bought here, sold here, bought here, that's one loss. You bought, that's 2 losses because you went short, and then there's basically 3 losses. So even if you can manage that and do that perfect and go long here, you're not going to make up everything you've lost, and you might be emotional about it, and then you're saying, I've got to make a profit. This thing has to go up because I've got to make up what I lost, and then the market does this, and you've just taken another loss on the day, and then there's just no way you're going to make it back. The only way you're going to make it back is if you start becoming super aggressive, and that's not the greatest idea. That's not a good idea. So, big bear bar, outside down, big risk. Think about it. Is this going to lead to a strong trend, or is this a sell vacuum test of the June 28th? Well, it might be a sell vacuum test of the June 28th. And then we got a doji. So what happened here? Well, again, if I'm selling, this disappoints me. I may sell here, and even if I sold more higher, I'm all of a sudden interested in taking profits down here. Because if I sold, I wanted the market to go straight down. If I sold here, I wanted it to go straight down. I want this bar. I want to sell, and then I want the bar to immediately sell off. I don't even want there to be a tail above the bar. Here, this open, I don't want there to be a tail above the bar. I want the market to just go straight down. And when it doesn't do that would disappoint me, and that would disappoint everybody else. And I get it. Computer disappointment is a radar. If you hear Al talk about that, obviously an algorithm in an institution in a computer is not emotional. But the one advantage you have is you can think with emotions. You can think with logic. You can say, oh, gee, that's disappointing. That shouldn't have happened. Maybe it's a leg in a trading range. I'm just going to scalp out. And the market started going off, started selling. Guess what traders are going to do on this bar? We had a strong bear bar. We hesitated. If we have another strong bear bar, guess what's going to happen? We're below these lows. We're probably going to hesitate. And we hesitated in a really, really big way. And here, you can buy the close, but again, same problem. It's forcing you to buy in this middle of this ugly range. Tight channel down, 1, 2, 3 bar micro channel, 50% pullback. So that's just not an ideal trade. also, bears, it's technically a breakout. We may retest down here, so some bears will sell more higher, use a wide stop, expecting they can get out right here. And what happened right there? Well, some bears took profits here. The market closed on its low and immediately sold off. Now you have a wedge. 1, 2, 3. So as I was saying, wedge bottom, 1, 2, 3. Probably, is it sell the close, buy the close? I mean, again, we've been having bad follow through here, after, bad follow through here. So bad follow through after every basically bear bar, probably going to reverse up. So a lot of traders will not be thrilled about selling this close. Doji bar, yeah, it's follow through, kind of looks like follow through, but think about the logic. It is a low one short, bottom of what could be a trading range, 2 legs down, it's a wedge bottom. So again, that's just not that great of a short. Do you really want to be selling this low in what looks like a trading range? Probably not. Very big bull bar. Bears probably exit a couple points above this bar. And, again, look at the open of this bar. When it goes down 1 or 2 ticks and assumes and reverses up that quickly, that is a sign of strength. And traders are going to be really quick to take profits. Again, they're expecting a trading range. If they're expecting a trading range, they're expecting a reversal up. Traders don't want to hold through, they want to hold through pullback when the risk reward makes sense. The reason traders scalp is because they don't expect the move to go that far. That's why they sold below this bar, because they expected price to go down a little bit and maybe stall. So big bull bar, follow through bar, probably always in long. This is still a problem for the bulls. We'll probably get to the moving average, probably going to test the June 28th low or a June 28th high. Again, it's the most important price level probably of the day. So it's going to be retested. I would expect the market to go sideways around it. So probably by the close. Again, just as the bears were disappointed on the way down, the bulls may be disappointed on the way up. We had a high close up here, although the bulls that bought this close were able to get out break even on this bar. Maybe some would hold, so we could do something like that. Maybe test back up to here, and it's around the open of the day, so that's kind of a magnet. But anyways, nonetheless, it's probably by the close. Odds favor second leg. Bear bar, you can call it a low one short, but not a good buy below. Bears are trapped down here. They're going to use any pullback to buy back shorts, and then you got a big bull bar. So now you have a micro channel. 1, 2, 3, 4, 5, 6 bar below micro channel. Possible wedge top. 1, 2, 3. Breaking above the moving average. So again, it's still probably by the close. I think you're going to get to the moving average. We closed above the June 28th high again. We got to the moving average. I think we're going to get back to the open of the day. And I think we might get all the way back up to here. So still, the bears haven't done enough. Even if the bears get a bear bar, it's probably going to go sideways and let the buy the close traders out. And then we got a very big bull bar. So what happened right here? Well, there's a measuring gap. Bears sold this high, disappointed on this bar. They might try and get out at break even. And someone asked the difference about limit order traders and stop order traders. I'll talk more about that in a little bit, but this is the difference. Limit order traders bet on failed breakouts. Stop order traders bet on breakouts. You cannot have a market where both are maximized. They're doing really well. A strong breakout traps limit order traders. Limit order trader sells this high. They get trapped. They try to reduce their loss by getting out as low as possible. Limit order trader sells this high, gets trapped here. They try and get out break even. Some limit order traders, they buy the June 28th low, scaling lower, get back out. They buy the June 28th low, buy more lower, get back out. They buy more lower, get back out. Consecutive bull bars, yeah, you can call it a wedge, but again, strong enough breakout, probably going higher. So probably by the close, at the open of the day, probably going to get up here. May have a pullback though first. Then we have a third really big bull bar. So, we have a measuring gap this high, this low. Maybe I'll start with, there was your first target. I forgot to mention that. Here's another one. And maybe this is the other target. But I'm going to delete that. I don't think it's too important. So anyways, 3 bull bars, and you may get a pullback. However, again, probably buyers below, probably at least second leg up, and not enough for the bears to sell. Some bulls bought this close, bought more lower, getting out break even here. Bears, they know it's a bad high one buy, so they'll sell it, scalp out, which is what happened. Close at these lows, not below it, but even if it did close below it, do you really want to sell after this tight of a channel when you're expecting a trading range? No. This is not ideal for the bears. 2 legs down, pause here. So we may get a bull bar closing on its high. The bulls want a second entry buy here so they can buy again. And then we got a big bull bar, probably buyers above, probably going to get to this high, probably going to get up here. And we had a very strong bull bar right here. But the problem the bulls have is you're at the highs, probably going a little bit higher. It's getting to be pretty climactic. Buy climax, pause, second buy climax, pause, third buy climax. Best looking bear bar of the day. So if it's the best looking bear bar, does that mean it's climactic and you should sell it? And you can sell it to get out of longs, but I would not sell it to sell the close. You shouldn't short the bar. That's not that great of a trade, and it's a difficult one. So bulls, some will buy the close, others will wait to buy a pullback. Maybe they buy the low of this bar, maybe they wait for a couple legs down and buy the second entry. There's nothing wrong with getting out below this bar and buying again here. It's the same trade as buying here, scaling in lower and holding back up here, or as just buying and putting a stop and waiting for here. It's no different. A lot of traders, another concept to talk about for another day is the more you think about the market, you start thinking more about risk management and protection of risk. And the easiest way to protect your risk is to not be in the market. But if you're not in the market, you can't take any trades, and that kind of obviously defeats the purpose of trading. However, a lot of traders will get out of moves anticipating to get back in. Al does that all the time. And, there's certain stop entries he'll take that I know drive people insane because he'll mark it up on the end of day on the website, and people can't understand why. Maybe he'll mark buying this, close of this bar, or even buying the close of this bar. I'm not saying he would, but that could be an example. But anyways, it's reasonable to get out here, and if you can get back in here, it's basically the same entry price. So some bulls buy this close, scaling lower, get back out around break even. Others, they buy more lower and just get out when price comes back to here. Maybe the market's turning up strongly, so they hold regardless if they got out. Some traders will buy this close again, confident that the first versatile down is going to fail, and these gaps are staying open, and the market's going to have to go sideways. Worst case for the bulls. Then we got a strong bull bar, so bulls buy, and guess what? They could buy again. They buy this close, huge bear bar, but is this enough to reverse this? No. So they'll buy more lower, and guess what they're going to do up here? They're going to get out of break even, and high one buy. This could just retest up here and turn down. So some traders, maybe they get out during this bar, and then if you get consecutive bull bars, it's, can you buy above it betting on another breakout? Sure. It is a strong trend. Now, the odds start to favor a deep pullback, so it's not, makes it more difficult, but you can still do it. Traders will probably do it. And there's another breakout. So what about buying this close or the next bar? Well, it becomes more and more difficult. You're far away from the moving average. Buy climax, pause, buy climax, pause, buy climax, pause, another buy climax, pause, probably, what are we going to do up here? It's probably going to be another buy climax. So it's unsustainable. And the most important thing to do is It's okay to not buy and look for a pullback. That's fine. The worst thing you can do is I'm going to look to short anticipating a pullback because you may not manage it correctly. Even though we're pulling back here, well, what if you didn't get out right there and, obviously here you could have made money. However, what if you did that right here, And again, it's kind of like, okay, this bar's climactic, this bar's climactic. What makes this bar different? And sure, there's a couple of reasons, Strong breakout, reset the count. Second breakout, maybe that's strong enough, reset the count. Third breakout, that could be strong enough to reset the count, but probably won't be. So, either way, key point, don't look to short in a strong trend. It's really difficult to do, and it's not, the math really isn't that great. So if most people could stop doing that one thing, they'll be way better off. Okay, pause bar, so bulls bought the close, and we have a doji. Well, what are they going to do? They're going to be disappointed. They're going to look to get out break even. Almost outside up, high one buy. Again, might be sellers above soon, so some bulls may take profits above, take profits on the close, which is why I turned down. Micro double top, up, down. Some bulls will certainly get out below. Consecutive buy climaxes, wait for 10 bars, 2 legs. High one buy. Again, bear bars, probably another leg down. Like that. Bulls trying to get out break even around this close. Testing these highs, and boom. So what happened here? Why did this go from here to here? Well, bulls bought the close, scaled in, retest, sold off. Well, what's going to happen down here? Well, big bull bar. Is this going to lead to a strong bear trend or go sideways? Well, it's probably going to go sideways. So what do bulls do? They're going to buy the close. They're going to buy the moving average, betting the price does not do what the bears want, and that's have a strong breakout. And boom, the bulls, they bought the close, bought more lower, and when it turned up, they got out. Outside down, bad stop entry buy, close at the midpoint right here, and tight channel, forcing you to buy in a tight trading range. And again, this is climactic, so probably going to get at least to the moving average and probably have a bigger complex pullback. Outside down, is this always in short? Are we getting a break out of a double top? So double top, break below this neckline, break below this neckline? No. This is going to be probably some sort of failed breakout. Bull bar, but here's a gap. This is a strong enough bear bar for a second leg down. Shouldn't I should sell betting on a second leg, right? No. These bears are disappointed. They understand it's a leg in a trading range. These bears understood it's a bull leg in a trading range. And they're selling because they're confident the market's going to have a second leg down. These bulls are selling, hoping the market sells off quickly. And if they're quick, as the market starts to turn up, they'll scalp out. They want it to go really, really fast their way. That's another thing. Probabilities change every tick. The probability does not stay the same on every bar. I could buy this close. If I bought this close, sure, the market went down here. But if you bought the close and you were disappointed and you got out back at your entry, that increases your probability of not losing money. So I think bears are probably going to buy back shorts sometime soon, even though this bar looks weak. And we didn't get above it. We got another bear breakout, starting to form a tight channel. But in case, from the bears' perspective, they sold this close. They're disappointed. Big bear bar. What do you notice on today that looks similar? Well, this looks kind of similar to me. We had a big bear bar, weak doji, big bear bar, weak doji. And then we have another big bear bar. And, this tail is bigger than this tail. However, probably going to reverse up here. Is this sell to close? No. And whenever the market becomes close to sell to close, kind of like where they need one more bar, you hear Al talk about that. Is it always in short? He would always say in the webinar, it might be, but, the bears probably need one more close. What is he saying there? He's saying that the market may reverse. Traders may buy the close instead of sell it, betting that the bears don't get one more bar. And there you go. So, is it a good buy? Well, it's a wedge. 1, 2, 3, 1, 2, 3. 50, it's a pullback here, but this channel is so tight. First reversal up still might fail, and we might retest these lows. So bull buying here needs a wide stop. In some bulls, probably better off looking to buy lower. It's really better if you can, wait to buy a micro double bottom. It'd be higher probability if this bar closed, as a bigger bar. If this bar closed as a bigger bar and price went above it and turned down. So bull bar, but again, probably going to have more sideways, and we get a bear bar. So some bears sold this close, they got out here, and they might re-enter here, betting that price will test here. I'm not recommending to do that, but some bears would do that. And then we got a really big bear bar testing this close, and we immediately turned up. So what happened there? Well, bears have been, breakouts have been retested all day, and most days breakouts are retested. So you sell this close, sells off, you make money. You buy this close, disappointed, buy more lower, price comes back to your entry. Buy this close, disappointed, you get out break even. Here, not really that great of a sell to close. It's a 50% pullback, tight channel up. Every one of these bars was retested. Buy this close, disappointment, retested, sold off. Sold this close, disappointed, could have gotten out with small loss, but really, deep pullback. Trader could sell this close, get out as the market started to turn up above this bull bar, or get out above this bar. And second entry short, we went up, down, so micro double top. Traders could sell again below this bar and get out around 50%, which would be here, or get out break even. So that kind of the same thing here. Big bull bar, maybe we'll break above the neckline of the double bottom neckline, go for a measured move. Bulls need follow through, they need a good entry bar. They don't get it, but still not good enough for a short. Bull close, somewhat disappointing, but closing under here, still probably always in long. I don't think we ever went always in short for another leg up. And we got a bull bar and a weak doji. And when you get that weak doji, traders that are buying closes, it's a warning that the market may not go up much higher. So traders, what do? They look to get out break even. There's too much risk of a developing trading range. Traders don't want to buy high in a trading range. They want to buy high in a breakout, which is strong momentum. So if they're buying high and they realize it's a trading range and they're wrong, they're quick to get out. Sideways, big bear bar. And then we reversed up. So bulls buying closes, scaled in, they got out, break even. No surprise. And here it's a wedge, 1, 2, 3. And this is a good example. It's kind of like this. The bulls, it's sort of, but big bear bar. The bulls stop entry on its high. The bulls triggered the buy and the market turned down. It's not a great buy. You're buying up here with the buy the close bulls, and your stop's a problem because you don't really want to buy high in a trading range using a tight stop. So the odds kind of favored a second leg down. And but some bulls will buy here, buy more lower, or buy more above this bar, and guess what's going to happen? Tested it, turned down. So again, trading ranges are very forgiving. Strong breakout bar, is it by the close? Probably. It's a micro channel, it's a wedge top. So some bulls might be quick to exit if it closes down here, but again, traders will probably buy. They're hoping for a measuring gap here and for higher prices. The gap's open, so may go for some kind of measured move. But again, it's a wedge top here, 1, 2, 3, 1, 2, 3, late in the day, so the pullback might be deep. High one buy, could be sellers above, but again, bulls that bought this close probably will be forgiven and be able to get out without a loss. And look what happened right there. So late in the day, you can call it another wedge, small failed breakout of this bar to double top here. It's a short below the bar, tight trading range, just above the moving average. It lowers the probability. The channel up's pretty tight. And, again, you got to ask yourself, what are the bears really going to accomplish selling below this bar? Probably not much. And fun fact, it didn't trigger. So the bears that sold the close on the open, that front ran it, they got in before the bar triggered, are now trapped. Some bulls, when this bar closes, will buy at the market, put a stop 1 or 2 ticks below the bar, trying to prevent the bears from triggering the bar. And inside bar might go a little bit higher, called a triangle. But again, late in the day, probably better to do nothing. Doji bar, so again, probably buyers below, but again, it's tight trading range, not worth doing much. Bull breakout, follow through bar. But late in the day, it's basically 3 o'clock and there's 2 bars left, so quickly sold off. That's another good example, by the way. When you go to buy the closed market late in the day, you've got to be super, super quick to make decisions. And typically in a buy the closed market late in the day, you're just better off getting out below the bear bar or a couple points below the bull bar, because if you try and get out of break even, you could get this. So you could easily buy this close, and you could say the market's been letting me out break even all day. I'm going to get out of break even, and that doesn't happen. Consecutive bear bars, best to get out below the bar, which is why, again, notice this bar didn't even have a tail above, and then this bar didn't have a tail above. So important to recognize that. Limit orders, probably the first limit order. I don't know, there's not really easy ones, buying this low, maybe buying this low, buying here maybe. Traders bought this low. I'm trying to be careful about limit orders because, buying this low but late in the day, there's a lot of limit orders here. But they're challenging to manage. Traders will, trying to think of when they'll sell this close, they'll scale in higher, get back out at one contract on their first entry. They'll, there's a couple. Traders will buy here, buy more lower, buy this close, buy the close, buy the close. So, not too many obvious limit order trades today. As far as I've talked about buy the close, I'll talk about stop orders, which is really always in trading, which people mostly should focus on. So let's do that real quick. I've already done that. I'm going to zoom out. So when was the first clear always in short trade? Maybe buying above this high or this high for the double bottom breakout, but then bears probably get out below the bars. The market goes outside down. You can sell the close, but again, not great if you do. If you do sell it, unfortunately, you probably have to get out above the bar, but it didn't trigger. And then you get out during this bar. Aggressive bulls buy the close. And, they can get out there for the wedge. 1, 2, 3. But if they do, they buy again here. Or, above the bull bar. Maybe above this bar. Second entry, maybe they can get out here. They probably get out below this bar. And, if they do that, maybe they buy again here or above here. If they bought here, they hold through the pullback, or they buy here. And, it's not clearly always in short, so you don't technically go short. But again, it's trading range, so I don't necessarily want to be long up here with 3 dojis. I'd rather buy lower, but, if you had to do anything, stops down here, you hold through this. And if you get out, You wait for a bull bar. Do you buy above this? You can, but again, tight trading range, not far from where you got out. And I only want to buy high ones if the market's really strong. Strong breakout. Here's kind of a high one, but it's it's a high two variant on a smaller time frame here and here. Trying to find another high one. Here's a high one, just buying above the bear bar. That's good. And high one here. But anyways, so second entry buy is probably more ideal. Bulls buy, don't have to get out here. Some will because it's a new high of the day, and then you probably get out below the bar, but it didn't trigger. By the close, bear bar, bulls get out, and no reason to do anything for the rest of the day. So I'm going to answer a few questions I've gotten, and I'll just go in order. Someone asked, they said that the close was odd. No energy in the final 10 to 15 minutes. They do not know what to make of the behavior. Seems like it should have pushed to 4,000, the big round number, much earlier and faster, or it should have backed off. Yeah, I mean, sometimes the market does that. There's a couple other things today. You had the high of yesterday. So you got to think about the daily chart. And you had this major high, June 28th. You had the high yesterday. So the bulls really wanted to close above yesterday's high, which will also be above June 28th. And that's a pretty challenging task for the bulls. That's a lot of, the bears know that, and the bears want to prevent that because the bears wanted, again, they wanted this double top. They wanted this to fail and lead to a sell-off. And it doesn't look like we're doing that right now. So that happens a lot. And the other problem is when you get this much selling on the open and you get a rally that pauses, another rally that pauses, another rally pause, another pause, another pause. It's the same thing as saying, buy climax pause, buy climax pause. It's consecutive. And traders are really confident that this first reversal down is going to fail. They're really confident this reversal down is going to fail. And the reason is it's a strong micro channel. They're probably confident here, maybe here. But eventually, you get less and less confident there's going to be a second leg, or a third, or a fourth, or a fifth. So traders take profits and they want to wait for a correction, trading range. So we broke above this it's triangle here. We broke above it, tried to pull back in the apex. Maybe we'll retest this triangle late in the day. Even here, it's, and again, it can be, I totally get that. And I would be more so, I would just look at the chart and, if it's giving you this, probably better not swing trade. It's hard to catch, and that happens enough on higher time frames where institutions, they drive the market one way in the final 30 minutes of the day, and it's really hard to catch those moves in the latter portion of the day. I mean, you look at this, it's a double top, bears get out, bulls probably get out below the bar, but then we just kept racing up. So, and the reality is, the stock market's closed, futures market's open for 3 minutes. I mean, not ideal. And hope that one helps. Can you discuss trading ranges versus open gaps in a swing up? I was confused with feeling like it was a trading range, but doubting it was a trading range due to all the open gaps. Gaps usually close in a trading range. So, thoughts? Yeah. That is the quandary of small pullback bull trends. That is always the question traders have. That it's never clear. It's clear that it's going up, but it's never clear if it's the top. And that's why I emphasize buy the close, sell the close so much. Traders will buy. Yeah, so gaps, and I had to pause the video for a second. Gaps and legs in a trading range. Most traders will. That's why traders like buy the close, sell the close. Because it's a strong enough breakout for a second leg, and you get a strong breakout. Traders are going to buy the close, confident the first reversal down will fail. And if the reversal down fails, and it's disappointing, then it's probably going to be a trading range. And here's a great example. This isn't ideal. It's a wedge top, 1, 2, 3, consecutive buy climaxes, but a trader that bought this close didn't get out quick. They could have bought more here. Plenty did. And they're going to get back out at this high close. I mean, do you really want to, if you bought 11.30 and you had a sell-off that was what? 87 to 73. I mean, if you held 10 points lower over an hour, are you really thrilled about where you bought? No, you're disappointed, so you're going to get out the high close. So gaps, I'm going to kind of answer two questions in one here. Someone also asked about what's the difference between a limit order and a stop order, and that also involves kind of the same discussion of what's a gap and gap failures and trading ranges versus small pullback bull trends. And the real difference is one side is trapped, the other is not. So what do I mean by that? A gap traps traders. How does a gap trap traders? Well, you've got to be, the easiest way to learn this is to get trapped in enough trades and take a loss. And you'll learn pretty quick how limit order traders get trapped. Limit order traders have one fear. Their fear is, we had a great day a while back. I'm going to pull that one up. I really like it. It's last Friday. Hang on. I'm going to find this day. I think it was the 15th. Went too far. We're almost there. And I think this is the day. Is this going to be the day? No. Hang with me. Yeah, here it is. Here's the perfect. Yeah, this here's one. So, and again, I haven't forgotten the question about gaps, but I want to explain both. And someone asked about explain limit orders and stop orders. Limit order traders bet on failed breakouts. A stop order is buying above a bar, and limit order is selling above a bar. It's the opposite. And a great limit order trade is a bad stop entry trade. So let's find a bad stop entry. Here's a low one short. Bad stop entry, great limit order, reversed up. So bears, bulls, buy the close, market reverses up, they take a quick profit. Al calls it little bags of gold. And they just take them real quick. It's sell the close. Here, let me find a better example. Sell the close, bears sell more higher, scalp out. Limit order traders will bet on failed breakouts of everything. And if they do a lot of those trades, they can rack up a lot of points and have a really high winning percentage. So what does that mean? Okay. They buy this low down here. They sell this high up here. It's trading range. They sell up here, scalp out. Buy this low, price turns up, scalp out. And they're scaling in. They sell above this bar, scale in higher, scalp out, sell above this bar, sell more higher, scalp out, sell here, disappointing close, so it's probably not quite buy the close, sell more higher, scalp out at their original entry. They buy this low, scalp out, they sell this low, sell more up here, scalp out, they buy here, they buy more lower, scalp out, buy this low, scalp out, sell up here, turns down. There's so many of them, and if you just do the math, if you can make 4 or 5, 3, 4, or 5 points on every one of those trades, that's a lot in a short period of time. It's hard to do that though. So what happened over here though? Traders buy this low, scale in, scalp out. Buy this low. Maybe they bought this low right here and they had a deeper pullback. Price retested it and they scalped out. Well, that's good so far, but it's almost sell to close. So traders are going to wonder if the market's going to retest below close. Traders sold here, scaled in, and the problem here though is bulls got trapped in here. Bulls bought this close, they bought this low, scaled in, couldn't get out of break even, so that's a warning right there. That's kind of a gap. That's a gap right there. Trap traders. And bulls, they buy this low, scale in, maybe they took a quick profit, but what about the bulls that bought this low, and this low? Well, I've talked about this bar a couple times. This bar closed 42 bars, closed below 42 bars. So if you go back to here, from this bar to this bar, that's 42 bars. That's significant. That traps a lot of traders. So a lot of bears, a lot of bulls who bought this low are going to just get out or get out on a small bounce because they're fearful that they might be trapped. And if they're trapped, that will force traders to buy back, to sell out of to sell out of longs on the way down, which creates a strong stop order market. And I'm not going to go in too much on what a stop order is because there's plenty of videos now made about orders, but I want to drive home the concept of limit orders and stop orders because it's really, stop orders want a strong buy the close market. They want a market like this. They sell below this bar, sell below this bar, sell below this bar, sell below this bar, and they make a lot of money. Limit order traders, counter trend traders, don't really want this because they want to trade reversals back and forth. They don't want to trade this. This is a counter trend trader's worst nightmare, which is why they have to get out quickly. Now, the problem with limit order trading is that everybody understands if you scalp with limit orders, you can do really well and you can have a really high winning percentage. But the problem with that is you have to rely on winning percentage in order to make money. And I'm going to pull up a spreadsheet here. So here's a spreadsheet. And what I want to talk about on the spreadsheet is basically the trader's equation summed up in a few examples. So in the first one, you have going for 1-to-1, 60% profitable. Outcome of 0.2 is, again, I'm just using units. So your risk is 1, your reward is 1. Reward's 1, risk 1. Yield's 0.2. 0.2 of what? 1 is the best you can get. 0 is the worst you can get. Negative's losing. So case in point, 0.5 is a 0. 0.51, 0.02. 0.99, 0.98. But you can't get 1. It's impossible. The only way you get 1 is if you had a 1 right here. Not going to happen. So this is kind of marginal. And the reason it's marginal, 1-to-1 risk reward at 60% is the exact same thing as being 40% profitable going for twice your risk. So if you look at these two, ask yourself, what's easier to achieve? Is it easier to be 60% profitable going for 1 times risk, or is it easier for me to be 40% profitable and go for twice my risk? It's easier to be 40%. And this is really what I want to drive home. If you can have a 2-to-1 risk reward, always go for twice your risk, and be somewhere in the ballpark of 50%, that yields 0.5. That's really good. And even if it's 0.45, that's better than these. In order to, and let's just get out real quick, going for less than 1 times your risk, you need to be 80%. This right here is the same thing as this. So if you're going for less than 1 times your risk, you need to be 80% profitable to make that worthwhile. And that is not that challenging. And while we're on that, let's just talk about going for 1/3 of your risk, because I think it's like 92%. It's 90%. You need to be 90% profitable if you're going for 3 times. If you're going for less, if your reward is 1/3 of your risk. So I hope that's really important. It's extremely important to understand, and I hope you guys realize that. So out of all these scenarios, this is what you want to focus on right here. Go for twice your risk, be 50% profitable. If you can get that, if you can get 55% profitable, more power to you. But 40% gets you in the positive. So that's just mathematics. I mean, that's you still got to understand what to do, but that's just math. It's a spreadsheet. It's not anything too crazy there. So last little question here. the fourth push up to bar 37. Turn on my bar counter here, because I don't remember what bar 37 is. Okay. Yeah, that's 37. So he's saying the fourth push. 1, 2, 3, 4. I'd agree with that. It would have been a nice wedge at bar 32, but no sell signal after the 34 bear close. I think it means here. So it would have been a nice, I think it means shorting below this bar. Well, a couple problems with that. Now that we know, I'm going to turn off the bars. So basically, this would have been a nice wedge if this would have had a bear close. I don't think it would have. And the reason is, the problem with wedges is you can often get another push up. So strong enough breakout, likely to get 3 pushes. Well, this might be strong enough to start the count over. Markets typically reverse after 3 pushes up. They have a couple legs down. So when you get a bull breakout like this, the odds favor 3 pushes. We have 3 pushes. I get what he's saying. 1, 2, here's the third push. The problem, though, is more often than not, the second push is strong enough where the second push might get 3 pushes. Here's the second push. This might have reset the count. 1, 2, 3. It's also a measuring gap, so you got to think. We got that later in the day, but you may get something like that. But nonetheless, that's your first push, that's your second, that's your third. And, again, I know it's really tempting to want to look to sell wedges, but you have to think about it from the perspective of bears making money. Bears did not make really any money from here to here. I don't consider this making money selling below this bar. I don't consider this making money. Why? Because my risk at a minimum is the high of this bar, and that's just not ideal. So if you don't make money for this many bars, it's probably going to go sideways for some time. So I wouldn't, I wouldn't sell it even if this closed on its low. I wouldn't be a fan of that. It's 50% pullback. And I'd be thinking, I want the bears to show me that they're in control. Show me they're in control. Do this, and then do this, and then retest these highs. And, again, it took 2 hours, and the bears couldn't do anything. All they could do is prove to everybody that they formed a triangle like that. And the bulls still got an upside breakout. Also, look at the moving average. The bulls have been willing to buy above the moving average since here, maybe here, to here. What do you think they're going to do when they get to the moving average? They are going to probably buy. So that's all for those questions, and I hope y'all enjoy this video.